is a money market. So when you're talking a bank lending to another bank to meet the requirements, that's a money market transaction, because that's an overnight transaction. It's pretty riskless, and there's an active secondary market for it, very short term. So I'm going to propose this to you guys. One of the reasons that money market accounts exist, incremental to banking checking accounts exist, has to do with this. Does that give anyone a clue?
There's less restrictions on money market accounts?
Yes, yes. So this gets into an interesting discussion on what banks do, why banks exist. Now, can I ask you guys to think back to your, probably the second class period, to see what are some of the justifications for financial intermediation. Why do we have financial intermediaries?
Reduce transaction costs.
Bingo. All right, reduce transaction costs. So financial intermediaries reduce transaction costs. Okay? One important transaction cost that financial intermediaries reduce, in fact, arguably the most important transaction cost that financial intermediaries reduce, is info asymmetry costs. I should say are info asymmetry costs. Okay? Information asymmetry costs, or examples of them, would be, I have to deal with Mario over there, and I don't really know whether Mario's going to pay me back or not if I lend him money. I'm not a specialist in this. So if I give him money, I'm going to price into the rate that I lend him money at a possibility of the uncertainty. Like, I'm not sure if he's going to pay me back or not, so I'm going to give myself an extra buffer just to control for the scenario that he's going to pay me back. In other words, there's more risk for me. In contrast, when a bank lends Mario money, they're specialists. They can do their due diligence on Mario, and they could give a precise estimate of whether or not he's going to default. And so, because there is less risk in the transaction, they're able to better see whether or not they should lend to him or not. They have reduced the information asymmetry, and thus they don't have to price that extra buffer into the rate that they give him. Whereas I can't see what his actual risk is, so I'll protect myself by pricing an extra buffer in there, okay? So these are info asymmetry costs. So that was one example of an info asymmetry cost, information asymmetry cost, okay? So one thing, so these are the benefits of regulation, right? The benefits of regulation, the benefits of financial intermediation is they can reduce info asymmetry costs. But these benefits come at a cost. If you get money out of a bank, banks have to deal with this. Banks are heavily regulated institutions. These carry their own costs. Okay? What are some examples of regulatory costs that banks have to deal with? Builds off our banking unit, regulation unit. What are some things that banks have to pay that normal corporations don't have to pay because of regulation?
Federal Reserve.
You got it.
I want
Reserve
to.
requirements, okay? So any other corporation, if they have cash, they can deploy that cash as they see fit. A bank, it can deploy 98% of that cash as it sees fit, and it has to have 2% of that cash just sitting there and not doing anything for them. Okay? So reserve requirements are a definite cost to banks. Okay? And if banks have to pay that cost, they're going to price it into their products. So ultimately, consumers have to pay that cost. Be it you're making less money on your checking account, or be it your loan rates are a little higher. But they're going to transfer those costs to you. Another example of regulatory costs are quite simply insurance premiums. Insurance premiums, right? Banks have to pay for deposit insurance. GM does not have to pay for deposit insurance. Very simple. The last regulatory cost that I'll mention here is interest rate regulations. It was more of an issue before the deregulation in the 80s. There's still some sort of restrictions on interest, but not as severe. But okay. So these are just examples of things that banks have to pay for that are going to be priced into the product that you get from. Okay, so this is the benefits of financial intermediation. This is the costs. When you're dealing in a high info asymmetry environment, when it is one very obscure borrower that people don't have a lot of information from, who seeks funds, these costs are the benefits of financial intermediation. So financial intermediation, reduced transaction costs, that equals a benefit. Okay? The benefits of financial intermediation outweigh the costs. So these are going to be priced into your loan rates, but banks are going to be able to more precisely estimate your credit risk, so they're going to be able to give you much better loans, much better loan rates than if I were to lend you money. Okay? So here you have benefits of financial intermediation. Here you have costs. And when there's a lot of info asymmetry, for instance, in the case of a private borrower, these benefits are going to outweigh the costs. The bank is going to be able to do much more, and it's going to justify paying these incremental little costs. Okay? In contrast, what happens if a very public, very visible corporation that's rated, whose debt is rated AAA, borrows money? Is there going to be as much info asymmetry in that borrowing as there is for the individual borrower? No. Okay. Why is that? Can somebody explain to me just so I understand that you guys have a handle on info asymmetry?
Wouldn't there be more information on like a thing like that people know, like in the public than on an individual?
Yeah. So a corporation, a big publicly traded corporation who has its debt rated, has to file quarterly statements with the SEC. These statements are publicly available. In addition to that, these guys have press releases, some of them every week. These guys have analysts following them and issuing information. So there's really not a lot of, relatively speaking, there's not a lot of information asymmetry. The asymmetry here is how much the manager or the company knows and how much the ultimate investor knows. Okay? If you think about all the information, okay? Sure, managers are going to know more than investors, right? But if it's the case of a small business lender, for instance, who doesn't have to file annual reports, a small business borrower who doesn't have to file annual reports, whose debt is not publicly rated, the manager is going to have almost all of the knowledge in that relationship, and the ultimate investor is going to have very little knowledge, okay? What banks are able to do is they're able to bump this up here. So the bank is now the investor, and it can reduce the information asymmetry. But managers still have more information than banks do, okay? In contrast, for big public companies, everything that happens has to be publicly disclosed. So information is going to be pretty much symmetrically distributed. Sure, the manager is still going to know a little more, but it's not going to be to the same extent that the manager would know more if it were a small business loan, okay? Are you guys following? Try to go fast so you'll be able to watch the game, but please stop me if you don't, because this will be tested. Okay, so what we've demonstrated is when information asymmetry costs are relatively low, then banks don't pose as much of an advantage. And so those deposit accounts that you have, there's going to be these regulatory costs priced into the rate that you get on the deposit accounts, and you're not going to be getting that much benefit from information asymmetry, from the bank being able to reduce the information asymmetry. So instead, you're going to put your money in the money market. okay? And we'll go over different kinds of money market instruments here. But did you guys follow that, or would it be worth restating why money market instruments exist? To bypass regulatory costs. When we did not follow that clearly? Oh, we did. I saw you shake your head.
No, I'm not I'm good.
Oh, okay, gotcha, all right. I asked two
You
different
said
questions.
when information asymmetry is lessened, then banks have a smaller advantage?
Yes, precisely. Yep. Banks can offer you less of an advantage in the rates that you get, either to borrow money or to invest money.
Just comes down to the benefit not outweighing the cost anymore.
Yes, exactly. So, why this gets back to what we talked about in our banking unit is, if you guys recall, our conversation about shadow banking. And we determined that one of the reasons that money market mutual funds exist is to bypass regulatory restrictions on deposit rates. Regulators couldn't pay deposit rates higher than 5%. Banks couldn't pay deposit rates higher than 5%. And so investors who faced inflation of 13% had to put their money in the money market. So that was bleeding the money out of the banking system into the shadow banking system. But that's just an illustration of how money market instruments have a competitive advantage over bank accounts in terms of regulation, because they are a under-regulated industry relative to banking. Okay? So we've been speaking of money market accounts, sort of generally speaking. Let's talk about specific money market accounts. Okay? So, not money market accounts, specific money market instruments. Okay? So, money market. So, okay. Most important money market instrument is the T-bill. And you guys are all pretty familiar with it. Up until 2008, you could buy T-bills in increments of, I think it was $100,000 or more, or maybe it was $1,000 or more or something. But anyway, after 2008, you can buy T-bills in increments of $100. So it made it accessible to the average investor, to you and me, instead of having to buy in denominations of, I think it was 10,000 bucks. I don't know. Your book says. Yeah, and T-bills are always discount bonds. What are discount bonds? Yes, they sell lower than par, they sell at a discount. And why do they sell at a discount? What do non-discount bonds offer that discount bonds do not? Interest in coupon payments. Yep. So, regular bond, a straight bond, a plain vanilla bond will pay you periodic coupon payments. Discount bonds will not pay periodic coupon payments. So, basically, these T-bills are always sold at a discount. Okay? So these are examples of discount bonds. Okay. They basically have 1 month, 3 month, and 9 month. I'm sorry. 6 month denominations. Okay? And one thing the book talks about, which will lead into the next unit as well, which is a pretty interesting distinction to understand, is the distinction between a liquid market and a deep market. And for T-bills, we don't have to make that distinction because the market is both liquid and deep. Okay? So, can you guys refresh my memory about what I told you, or what you guys probably already knew, a liquid market means? What's that? A liquid market. It's not a liquid investment. So we say there's a lot of liquidity in this market.
People can sell their instruments without fear
Yeah, yeah. So the broad explanation that we've been using is that people can sell instruments, can buy and sell instruments without worrying about being stuck with it because no one wants it, okay? But if we think about it, that decomposes into two components. That means that there are a lot of traders in the market. You don't have to worry about you not finding a trader, so. Okay? And that aspect of what we were referring to as liquidity is called a deep market. More precisely, a liquid market implies that there's a lot of money traded. Okay? This means that it's no good to you if you have 1 million investors who all have budgets of $3. Okay, if you have $1,000 security, you're going to have a really hard time unloading that security. You're going to have a lot of search costs to find all the investors. So it's also important to you that there's high dollar denominations being traded, and trillions of dollars being traded or billions of dollars being traded. I think in the stock market, there's book said something like $200 billion of stock traded every day or something like that. I'll tell you precisely when we get there. But it's also important to have a liquid market that there's a lot of money being traded, okay? But think about it conversely. If you have a lot of money being traded and it's all being traded between two hedge funds, then that's not going to do you much good as an investor either. Then you're still not going to be able to liquidate your investment at a reasonable cost because you're not in the circle. So in order to have liquidity, you have to have both these two components, okay? This is a more precise definition of liquidity. But in order to be able to not lose your money, you have to have both these two components, okay? So we talked about T-bills, which are the most important money market instrument. Second most important money market instrument, as Ruben alluded to earlier, are federal funds. And on a typical day, there is $250 billion traded. That means $250 billion worth of banks not being able to satisfy their reserve requirements. Okay? So this is also a pretty liquid market. There's a lot of trading going on. And it's a deep market too. It's not just that Bank of America has $1/8 trillion deficit and everyone else is pretty fine. It's that a lot of banks have deficits and a lot of banks have excesses, so they're able to trade. Okay. Repos and reverse repos are also examples of money market instruments. Can somebody remind me what a repo is? Or a reverse repo, if you prefer. Audrey, let you open your mouth. You were going to say something.
Is it like, I know you can get your house repoed, so it'd be like taking, no?
That's a completely different repo.
Okay.
That's repossessed. Sorry.
Okay, no,
That's when someone takes it back. I guess there's a similarity in the two, in that at the end of the day, something is getting repossessed. But Taylor?
It's buying with a promise to sell it back, or
Yes.
selling with a promise to buy back.
Yes. So in buying something, in selling something with the promise to buy it back, if I sell you these markers with the promise to buy them back, that means I'm entering into a repurchase agreement. I am giving you these markets and agreeing to markers and agreeing to repurchase them.
And that's a repo.
Yes. Shelley, did you understand that?
Yeah.
Yep. And usually the underlying security, what you agree to repurchase, is going to be a T-bill. At least when the Federal Reserve wants to shoot money into the economy, they do these repos with T-bills. They do reverse repo. So when they want to pull money away from the economy, they sell banks T-bills, so banks give them money, they give banks T-bills, and they agree to repurchase the T-bills in the future. So, Johnny?
They can repurchase it or they must?
They must repurchase it. So it's a contract, and not only must they repurchase it, but they must repurchase it at a specified price. So you can think of this basically as a discount bond. The only way that someone's going to make money off this transaction, if they give me their money right now and I agree to give them money in the future, is if the money that I give them in the future is more than what they give me now. So that's why it's like a discount bond. There's no coupons, paid, but basically I am borrowing money and I am just paying more money in the future. No interest payments or anything. Okay?
Who sells repos to who?
So anyone can sell repos to anyone, but one of the ways, the most important way that monetary policy is conducted in this country is that the Federal Reserve enters into reverse repurchase requirements with banks in order to inject money into the financial system. Or if we have too high inflation and the Federal Reserve wants to take some money out of the financial system, they'll enter into repurchase agreements with banks. So if I'm the Federal Reserve and you're the bank and this is a T-bill, I'm going to enter and I want to take money out of the economy. I am going to enter into a repurchase agreement with you. That is, I'm going to sell this T-bill to you. You're going to pay me money for it right now. You're going to get to keep this T-bill overnight. And then tomorrow morning, I'm going to give you more money, and you're going to give me this T-bill back. Okay? So tonight, I pulled money out of the banking system. Does that make sense?
For one night?
That's an example of an overnight repo. You can also do repos. They're always short term, but you can do repos for a month, 2 months, but a very common repo is an overnight one.
And that'll shift things in one night?
So they say, if you have the big enough dollar amount. But the other thing is, I'm rolling this over, right? So I do it in one night, and I give you I reverse this transaction the next day, and then I enter into another repo the next day, and then I reverse it the day after. So effectively, the money never really gets to get into the economy because I keep rolling over these repos. Does that make sense? And I can keep doing this as long as I want, and then one day when I think the economy's healthy, I'll say, okay, I'm not entering into any more repos.
Wait, so the Fed sells the T-bills to the bank to increase the amount of money in the economy?
So if the Fed, think about this, you tell me, you're the Federal Reserve now, and I'm the bank, okay? So if you sell me something, where's the money going?
To the bank, so to the people?
So you're the Federal Reserve, I'm the bank, and you're selling me something, right?
Yeah, so back to me.
Yes, so the money goes to you, the piece of paper goes to me. So you would do that to pull money out of the economy,
Okay.
right?
But I guess I'm kind of confused because like the bank or the people, okay, because the people buy the T-bill.
Yes.
T-bills from the bank.
Yeah. No. Okay. So T-bills, this transaction isn't between people and T-bills.
Okay.
It's between the bank and the Federal Reserve. Okay. So this isn't how T-bills get traded. That's a completely different story.
But that's just like an example of how.
Yeah, we need some kind of collateral to securitize this repo. It's most commonly on a T-bill, but it can also theoretically be on a book. I can sell you this book, and with the agreement to repurchase it tomorrow, right? And so if I sell you the book, then that means I'm getting the money. So if I'm the Federal Reserve and I'm concerned about inflation, and I sell you this book to try to take the money away from you, then I buy it back tomorrow, and I enter into immediately another repo to sell you the book again. And so I keep doing that until inflation is no longer a concern.
Okay.
Conversely, if I don't think there's enough money in the economy, if I want to boost employment or job growth or anything, I will enter into reverse repos, which is just the flip side of the transaction. Sam?
What would they buy for?
And then the percentage that is, like for example, in that example, you were the Fed, you sold us a T-bill, we're the bank,
Mhm.
and then you buy it back the next day.
Mhm.
So we get a premium on that?
Yes,
too,
so,
right?
you pay me $99 for this T-bill, and tomorrow I'll pay you $100 to buy it back. Does that make sense?
Then we turn right back around and do it again?
Yes.
Because the government is trying to control.
Money supply.
Money supply.
Yep. And so if you keep paying this money to me and only earning a percent return, you don't really physically have that much money to lend out to the people. So you're still, it's as if this money wasn't yours, even though you get it back every day, but you give it back again.
To break even.
Yeah, you're making a profit,
Right.
but yeah.
But it's like pretty minimal.
Yes, yes.
So they sell T-bonds or something like that to the bank, what do they buy from the bank?
T-bills, those exact same things.
Okay.
Yep.
And they just have, the banks will have those on reserve?
Yes, the banks are the biggest
They
consumer
have them
of
anyway.
T-bills, yep.
Okay.
You can, if you ever want a T-bill, you can go buy it through your bank, whatever bank you have. Ruben?
I'm assuming there's premiums on their grocery bills.
Yes, it's just the other side. So, yeah, I mean, you can structure the transaction whichever party needs money, or whichever party initiates the transaction, needs to execute the transaction, is gonna be the party that has to pay for it, right? The counterparty is only gonna be willing to do that transaction if they're gonna get some kind of benefit. We clear? Okay. These are pretty confusing instruments, but they're a minor part of what's going on. They're a major part of the Federal Reserve Union. Okay. So, CDs are also examples of money market instruments. Can someone remind me what a CD is?
Certificate of deposit?
What's that?
Certificate of deposit?
Yeah, exactly. And what is a certificate of deposit? Take a guess.
Certificate of deposit.
All right. So what is what's that?
Go ahead.
It's like a savings account that pays interest.
A savings account does pay interest, but it pays more interest than a savings account.
Because you can't remove it for a certain period of time.
Yes, that's the fundamental distinction between a savings account, which is a transaction account, and a certificate of deposit, which is a non-transaction account, is that you can pull your money out of a savings account whenever you want. But a CD, you agree to lend the bank your money for a certain period of time. There's 1-year CDs, 5-year CDs, 13-month CDs, they're always running these kind of specials. And if you renege on your contractual obligation to lend that bank money for a certain period of time, that is, if you say prematurely, hey, I want my money back, or if you call your investment, which is another way of saying it, then the bank's going to charge you a penalty for that. They're going to deduct 2 quarters worth of interest, for instance, from the total amount you'll get back. Okay? So, CDs. There's these things called bankers' acceptances. And I think of this as fancy words for a cashier's check. Does anyone know what a cashier's check is? Has anyone bought a car here? So when you bought that car, Sam, did you go up to the bank and hand them a briefcase full of cash?
No, I haven't written a check out of my account or cashier's check.
Cashier's check, yep. And so I could write a check with my little tiny check, and the bank sees this and says, well, you know, there's a chance this is going to bounce. I don't want this check. Why don't you go to the bank, Leo, and you get the bank to write a check on behalf of your account. So the check is actually from the bank's bank account, if that makes sense. So what's going on is when I buy a car and I go up to the dealership, I hand them a check. This check says Bank of America on it. And how that happened is I went to Bank of America and I said, guys, can you please move some money from my bank account into your bank account? And they did. And then I said, guys, can I withdraw money from your bank account? And they gave it to me on a piece of paper that says, this is from Bank of America. And I take this piece of paper and I give it to the car dealership.
It was actually a private individual on Craigslist, but yeah.
Okay, that works too. Then there's even more reason for that private individual to demand a cashier's check in a bank. And why is that? It's a concept we've talked about earlier today. Information asymmetry. Yep. He's less likely to trust you. You're more likely to screw over him than a bank.
And you don't want to create that type of cash either and get robbed and then
Right. And you sure don't want to tell me you're carrying that kind of cash, because I know the right people to rub. Okay, so a banker's acceptance is basically that on a larger scale, right? If the example the book gives is if a tractor manufacturing company wants to do business with a parts supplier in Japan. Tractor manufacturing company in the United States wants to do business with a parts supplier in Japan. They haven't done business before, neither of the companies are particularly big or well established. There's some healthy mistrust between the two parties. So what they do is they go to the bank and they say, "Bank, can we have a banker's acceptance?" And then they send this banker's acceptance all the way to Japan. Japan takes the banker's acceptance and cashes it into Bank of Tokyo, and everything works smoothly. And so it's another short-term instrument. I mean, these checks are good for X amount of days. I think, correct me if I'm wrong, but if you don't cash a check within 90 days, it's null? You guys ever hear something like that?
Some are 30.
Mhm.
Some are 30? Okay, yeah, I don't know
30
exactly.
days.
I never go to that boundary. I take the money as fast as I can. But, so yeah, it's a similar concept. It's a finite maturity instrument, this banker's acceptance. And it's short term, and it's very safe, because as long as the Bank of America or whoever writes this banker's acceptance isn't going to go under, then the investor is pretty much protected.
So a banker's acceptance, same thing as a cashier's check?
It's effectively a cashier's check on a business scale instead of on an individual scale.
So would they print you out a check, or would they handle the transaction?
They handle the transaction. They send the check to Bank of Tokyo. And the other person goes to Bank of Tokyo and says, "Okay guys, can I have the check?"
So it wouldn't be like a transfer, electronic?
Yeah, I don't know how to distinguish this from a wire transfer. There's like a physical document somehow involved, the banker's acceptance. A wire transfer, there's not. Everything just goes on in the wires. But yeah, it's close to that.
What is the reverse side of that? So like, for example, the example in the book, company A is buying a tractor from whoever in Japan.
Okay.
So how do you secure that you're gonna get your product if you're paying them back?
Okay,
I
so
mean, I know it's off of topic, but.
yeah, I'm sure that's written into the business agreement. So the bank holds on to the check until I'm satisfied with my product, and I call ahead and say, "Okay, you guys can cash this." This is my total guess on it. I'm not sure. I haven't done any kind of transaction like this, but it's a good question. I'm not sure. Yeah, okay. And then we get to other pretty important types of money market instruments, and one is called what's called commercial paper. You guys have heard me talk about this for a while. So someone remind me of what commercial paper is? Or maybe I was just talking to my head, and you guys haven't heard me come in.
They said as long as you don't answer yourself, you're okay.
Oh, now I gotta think about that. So, anyone know what commercial paper is? You say something? Is it cash? It's close to cash. But again, it's another non-cash instrument. And that's the other thing the book starts with a caveat is that money markets are a misnomer because you're not physically exchanging money, but you're exchanging instruments that are as close to being money as possible. So it's not quite cash, but it is a promise. It is a very short-term bond, right? So the U.S. Treasury issues Treasury bonds and Treasury bills, with the main distinction between the two that Treasury bills are issued for short periods of time. A corporation doesn't have corporate bonds and corporate bills. They have corporate bonds and commercial paper. So commercial paper is the corporate equivalent of a Treasury bill in that it is just a bond for a very short period of time. Okay?
Made by companies only.
Yes, made by private corporations only. And this is has to be necessarily under 270 days maturity to get around SEC regulation.
You said made by private companies only?
Yes, private companies. Well, I mean, not like companies that don't trade on the stock market. So, because a private company is also a company that doesn't trade on the stock market. But I mean, made by corporations, like for-profit institutions only. So not the public sector, not the government, not non-for-profits. I mean, it doesn't have to be a corporation, it could be a limited partnership too. Just for-profit institutions. Okay.
They have to be less than 270 days.
Yes, and pure commercial paper is always unsecured. Uh-huh. And Elizabeth, you were here last class, right?
Mhm.
So, I think I used this term, correct me if I'm wrong, but what does unsecured mean? Maybe
Not backed by assets.
Yes, so it's not collateralized. There is no collateral backing it. So the distinction between debt is debt can be collateralized or have some collateral behind it, or another way of saying that is secured. It has security in case the debt defaults, the bank can go after a specific set of assets. Or it can be unsecured, in which case it's a debenture, not a mortgage. But
So an asset-backed commercial paper would be
yes, so
secured.
pure commercial paper is
Oh.
unsecured. Then we have asset-backed commercial paper. Sorry. Asset-backed commercial paper. And
Does a commercial paper come in blocks, or is it just any XYZ amount?
it comes in large denominations only, I think. Commercial paper is typically issued, I didn't write it down, but it's typically issued in over a couple 100,000 or over a
So
million or something.
who buys the commercial paper?
Banks can buy commercial paper, or other companies can buy commercial paper, or investors can go to Charles Schwab and say, look, I need something liquid in my accounts, can you buy me some commercial paper? Charles Schwab will buy a bunch, and it will allocate, because investor maybe only has $50,000 to spend, that's not enough, but if a bunch of investors get together, Charles Schwab will be taking in the interest from the commercial paper, and they'll be paying all the little investors.
So the commercial paper carries interest also?
Yeah, de facto. So it's not making coupon payments, but you're gonna buy commercial paper for $100, and when it comes to maturity, then that company is gonna pay you $110. So you're basically making periodic interest.
So the paper, the commercial paper will state what it is?
Yes, what it's gonna be sold back at. But
On
because
maturity date, under 270 days.
Right, exactly. But because there is heavy secondary markets for commercial paper, institutions are going to flip commercial paper very frequently. This is one of the more tradable. CDs aren't really traded.
Does the 270 start over every time?
No.
No.
So it's just a debt security that says this will be paid on September 4th, let's say. And I'll trade it to Ruben in a month, he'll trade it to Mario, etc. But it's still going to be paid on September 4th.
And it'll be worth less after that month, right? If you sell it to Ruben, when he turns around to sell it, he can't get as much out of it when he sells it to Mario, right? Or to me. Example, let's do $100.
Okay.
You gave him $100
So
you
who's
sold
the
him-
company?
You.
Okay, so I'm the company.
Uh-huh.
So I borrowed $100 from Ruben,
He gave you a coupon, you gave him a,
piece of paper.
piece of paper that
Mhm.
says worth 110 in
Mhm.
60 days.
Mm-hmm.
In 30 days, he turns around and liquidates it to me.
Mm-hmm.
Do I pay him the 100, or do I pay him 105?
It's all going to depend on what you perceive the credit risk is. So maybe if within that 30 days, I
Okay, so it's some complex formula.
it's not a formula. It's market expectation. Just like what's the right formula for a stock price? What's the
Right.
right formula for any specific
Okay.
asset? But if the expected cash flows haven't changed, then he wouldn't get rid of that security for any less than, let's say, 105, because he can hold on to it and make 10 off it. And you wouldn't pay any more than 110 certainly, but maybe you know. So it's just going to be market forces like usual.
Kind of like bond pricing.
Yeah, exactly. This is basically a bond.
All right.
And the last one, it's kind of interesting. It's called euro dollars. Now, what the heck are euro dollars? Seems like a contradiction of terms. Well, you actually have my people to thank for this. The Soviets invented this in the 50s at the heart of the Cold War because the Soviets were afraid that all the wealthy people that had money invested in U.S. banks, because let's face it, nobody wanted to invest money in Soviet banks, all these valuable dollars that were invested in U.S. banks are just going to get an abrupt freeze, like we did to Libyans, like we did to Iranians, like we do to most of our enemies. We just say, you shall not withdraw your money until we're not mad at you anymore. So the Soviets, being afraid of that situation happening, took all their money out and put it in a bunch of London banks. But because US dollars are much more valuable than Soviet rubles, they kept the money in dollars. And they negotiated with the London banks, hey, hold on to this dollars for us. We don't want your pounds, we don't want euros, didn't exist there, we don't want Deutschmarks. Keep these in dollars. And so that's why they're called euro dollars. They're US dollars that are held abroad. Importantly, it does not have to be in Europe, even though that's what these instruments are referred to. There's plenty of euro dollars in Japan, China, all that stuff. But the concept of a euro dollar is just a checking account that has US dollars abroad, not in the US. It's not quite a checking account that you can just write checks on it, but you're storing your money in a bank that's not in the US, but you're storing it in dollars.
And it would be, for example, my money stored in Europe in dollars.
Yes.
That would be considered a euro dollar.
Exactly.
And it would make interest. It would gain interest.
Yes, yes.
The fluctuation of the dollar.
Right, you would, yeah, I mean, that's a good question. I mean, typically when you invest your money with someone else, you would only do that expecting to get your money back. I suspect the Soviets, when they were putting money somewhere else, they were doing this more of a precautionary, protectionary measure. So they might have even been willing to pay a fee to invest their money, but I really don't know. In general, if you're, we can think of these as investments, money market instruments, and you're going to be having some kind of value. So if you think about it the other way is, even if the value isn't in getting a percentage of interest back, you're going to be you're going to be getting value now that you have safer money. Does that make sense?
Yeah, because you're whatever value that currency you are using, it wouldn't depreciate.
Yeah, exactly. That's,
if the dollar increases, you still have a dollar.
I would guarantee you somebody from Zimbabwe has most of their money in euro dollars instead of Zimbabwean money because they have hyperinflation. So their currency is constantly getting devalued every day. Okay, so these are all the different kinds of money market instruments. And we can go over a stupid digression that the book does in who uses money market instruments, and they waste your time just to say that everybody uses money market instruments. And so you don't need to read about that, but you can understand that governments can finance some of their operations, because governments will only receive tax revenue once a year, and so if they need to finance operations periodically, let's say it's September, and they receive taxes in April, then they can write a 6-month T-bill, let's say, to take in money now so that they can pay their employees, and in 6 months when they get all the tax revenue, they'll pay it back. Non-for-profits, you can have individual investors, so everybody does this.
On the asset-backed commercial paper,
I didn't talk about this, I'm sorry.
The only difference is that asset-backed is backed by the assets of the person that, or the bank, the institution that loaned, that put the.
So, okay, so basically, commercial paper, what is a commercial paper instrument? Somebody I haven't heard from. Gene, what is commercial paper? Yeah, you're right, I'm so forgetful, I'm sorry.
Something that you have to deposit or pay within 270 days.
Yes, so commercial paper is a loan from a company to an investor. I'm sorry, from an investor to a company. So the company needs to borrow money. In order to borrow money, they're going to issue a certificate that says, I promise to pay you money back. I promise to pay you this much money back, and I promise to pay it back to you on that date. Okay? And you bought this piece of paper for me, that is, you gave me money for it. And whoever gives me this piece of paper, you can trade it later, but whoever gives me this piece of paper later, I'm going to give them the money back. Okay? So, in traditional commercial paper, this is just my promise. This is just a piece of paper. In asset-backed commercial paper, this piece of paper also writes on it that if for some reason I default and I can't pay you back, then you get to keep my tractor. You get to keep my house, whatever. It's backed by an actual asset. So it's got collateral. Another way of saying that is it's security.
And those go for 270 days or less also?
Those go, yes.
Right.
Commercial paper is by definition 270 days. And to get around SEC regulation. Because they have to list it as a bond and they have to write prospectuses and they have to do a whole lot more paperwork. So, I will put the ball in your court. Topical basketball reference. We have 25 minutes left, and I ran out of things to say about money markets. We can get a head start on the stock market and get the boring stuff out of the way so that we can spend more time about the interesting stuff, or we can call it a day.
Call it a day.
But one? Does anyone want to veto this? Yes, that's right. It's your money. You're vetoing it, Jackson?
No.
Oh, okay. You're calling it. All right. See you guys later.
I mean, we're still gonna, whatever we're gonna discuss at the beginning of next class, right?
Yeah, I was going to tell you guys some interesting stuff about dividend theory, PhD level stuff, but I don't know if we'll be able to have time for that. So that's what's going to get up. Your lives
Is it
might
gonna be on the test?
If I don't talk about it in this class, it won't be on the test.
Still sunny outside.